Fine. So can you just put in the comments if you can hear me clearly, if you can see me as well? Can everyone hear me clearly? Okay, perfect. Okay, so let's get started. The business lifecycle, tax planning for business owners. It's one of the key aspects. Tax planning is a key aspect when it comes to the business lifecycle, and we see many opportunities that are missed by both business owners and their advisors. So it could be accountants, solicitors, whoever it may be. There are a lot of opportunities that are missed throughout the business lifecycle. And this webinar is effectively going to highlight key areas of awareness for both, business owners and accountants, because the three work hand in hand, I would say, the business owners themselves, the accountants, and then the tax advisors. So in terms of, before we get started, about Aswat Tax, we are, as I say, a specialist chartered tax advisory firm, and everything you see throughout this presentation, throughout this webinar, are areas that we regularly get involved in. So we work regularly on such projects, and then we also work on other aspects as well, such as international tax matters when we're looking at residency, for example, previously domicile inclusive, not the case anymore, company residency, setting up offshore structures, property tax matters, for example, property incorporations, commercial properties, and anything and everything in between. In terms of who we work with and how we operate on a, very quickly, we work directly with business owners. So many of our clients are, the business owners directly, but then a lot of our clients are actually the owners of accountancy firms, where they'll have their client base and we'll work together when it comes to certain tax projects. In terms of what we'll be touching upon in this webinar, so we have structure on startup, staying compliant, remuneration strategies, the personal or linked investment company, R&D, capital allowances, other tax reliefs, EMI, CSOP, and growth shares, trading premises, property businesses, insertion of a holdco, demergers, EIS, SEIS, buying a business, exit planning, trade sale, inheritance tax planning. Now, to be very honest with you, this is a 1 hour webinar. I can speak about just one of these topics for an hour. Okay, so that's basically to tell you that this session is more of an awareness session. So I think that's the first step, right? When it comes to successfully utilizing tax strategies to mitigate different taxes, is the awareness. So this webinar is a lot about awareness, which is, I can do this in my business, or this is where we're heading, or my client is looking to purchase another business, maybe we should do it like this. So it's about the awareness. As I say, I can talk about each of these matters for a long, long time, but that's not the point of this particular webinar. Going forward, we'll dive into each angle on a monthly basis. Okay, so the first step, or the first stage of the business life cycle, is the correct structure on startup, right? The structure on startup is something that needs to be explored. And on a very high level, we have two angles. We have unincorporated and incorporated. So on the unincorporated side, we have the sole trader, and we have the general partnership, or an LLP. And incorporated, we mean a limited company. There are other structures, but these are the three main or four main that we'll touch upon for this session. Now, there are pros and cons with everything, right? There are pros and cons with everything. So pros for the unincorporated, but then there's disadvantages that need to be considered, and same with incorporated. So from a tax perspective, because that's what this webinar is about, from a tax perspective, obviously we have the limited liability between sole trader and limited company, general partnership, limited company, general partnership versus LLP. You have the limited liability aspect from a legal perspective, separate legal entities. But from a tax perspective, for example, if we touch upon the partnership, how does it work? So a partnership is transparent for tax purposes. That's the first thing to remember, which is that the partnership does not pay any tax directly. Rather, what happens is we have the partnership accounts, partnership tax return, and then the profits, so the figures from the partnership tax returns flow through to the self-assessment tax returns of each individual partner, who then pay their own personal income taxes. Okay, so that's one tax angle to remember when it comes to partnership, which is the partnership does not pay tax directly. Rather, the partners within the partnership will submit or declare the figure effectively from the partnership tax return on their self-assessment. With a sole trader, again, we're looking at the self-assessment tax returns, that format. And broadly speaking, the advantages there versus a limited company is that you have less administrative costs, right? If you operate via a limited company, which is therefore a disadvantage, you have the confirmation statement, the accounts to company's house, the CT 600 to HMRC, and general compliance matters increase, and therefore the administrative burden also increases on the business owner. Other matters or other angles would be around, for example, if we're looking at loss relief, if you're operating as a sole trader or a partner within a partnership, you have more flexibility if you're making losses, and therefore a general comment on a very high level, as I say, but if losses are expected in the first few years of trading, then broadly speaking, you don't want to incorporate at the start. So the structure on startup should remain sole trader or partnership. Okay, why? Because you have the flexibility when it comes to losses. And then once the company moves to a profitable stage, if it does, that's when you start thinking about incorporation. Again, a very general comment. So don't, this is not advice, but it's just, from what I've been seeing over the years, you'd start to look at incorporation once profits exceed 40, 50,000 pounds. Okay, so that's something to keep in mind. And that's where we start looking at the disadvantages of unincorporated and advantages of incorporated, which is within a limited company, you can potentially bring in family members and utilize their allowances, for example. When we're looking at unincorporated, the key disadvantage there is that you are taxed on all profits, whether you need the profits or not. So, for example, we had a dental client, 200,000 pounds profit, in the region of about 180, and the whole 180,000 pounds is subject to personal income tax, whether he needs the funds or not. So that's where the separate legal entity angle comes in as well. So there are many other advantages to either structure, but the structure on startup should be fully assessed, as well as the long-term plan, so a 5-year plan of the business. As I say, if you're making losses to begin with, but you expect to make profits, the starting steps would be to remain unincorporated. I hope that makes sense. So as we say, factors to consider: limited liability protection, so separate legal entity. But remember, when we're looking at a general partnership, an 1890 partnership, there's no limited liability protection. The limited liability protection comes with the LLP structure. So for tax purposes, still transparent, but the limited liability protection. So you have many accountancy firms, law firms, they operate with the LLP status. Privacy, so company's house, meaning that as a sole trader or a partnership, not an LLP. So the LLP moves into the limited company sort of angle, which is that accounts are submitted, for example, on company's house. As in that your information is publicly available. And also going forward, I believe that the profit and loss account will also be exposed, if that's a good term to use. The administrative costs, we discussed that, additional admin fees, such as accountancy fees and other costs. Tax rates, income tax versus corporation tax. Now, income tax, we know 20%, 40%, 45%, right? Corporation tax, 19, 25%, and somewhere in between. So again, we would say on the face of that, someone that's unlearned, they're unaware, they would say, oh, like we should operate via limited company because the tax rates are lower. But what needs to then be considered is the two-tier taxation for companies. And what do we mean by that? We mean that the company pays corporation tax at 19%, 25%, but the funds, the profits are stuck within the company. And then the second tier of taxation is extracting the funds in a personal capacity. And that's why I mentioned that, on a very high level, once profits exceed £50,000, that's when you can potentially start thinking of incorporation. Other corporation tax advantages, so as I say, it's, case by case basis, you look at everything. R&D super deduction allowance, R&D specifically, it's not available for unincorporated businesses. Tax loss management, we mentioned that the unincorporated structure, generally speaking, is better for losses. Why? Because you can extend losses against other income. And you can also carry losses back 3 years, and the loss relief rules can get complex, but broadly speaking, there's a lot more flexibility. In terms of key compliance areas, so key compliance areas, I'm just going to touch upon these. We have the monthly responsibilities, naturally, PAYE, NI through real-time information reporting, handling expense claims, tax and benefits. So we have taxable and exempt benefits, P11Ds, 6th of July and 19th of July, salary sacrifice documentation, employment regulations. So we still get the occasional case where we have to look at the status determination for IR35 purposes, VAT management, 7th of each month or quarterly. Annual reporting, this is one of the key areas that accountants would consider and business owners need to consider, which is the accounts need to go to company's house on time, as well as the CT 600 to HMRC. Corporate taxation, you have different rules in terms of 9 months and 1 day, but then you also have the quarterly payments for corporate tax. You have the CIS potentially, and personal taxation, which is for the business owners. So you have CT 600 on one side, and you have your self-assessment tax return on the other side. Now, accountants, I know this sounds basic to us, right? But business owners, it's quite complicated when you really think about it. Obviously, we look at this every day, but for business owners, it can get complicated. Like even the whole thing I mentioned about partnership taxation and how it works, the flow through or the look through. Same, which is that, you have the CT 600 to HMRC, but that's for the company, and you have something separate for self-assessment, and the rules are different as well, right? For example, self-assessment, we have the payments on account, so 31st Jan and 31st July. In terms of remuneration strategies, as I say, very high level, this is a topic that, again, I can speak about for a longer time, but we're going to, just touch upon the different things that need to be considered. So most would just consider salary and dividends. Salary 12,570, utilize the personal allowance, and then top up to dividends top up with dividends up to £50,000, and then you're stuck, right? Like there are companies that I speak to where, you know, they're making like £500,000-600,000 profits, but their key complaint is, you know, we can only take out £50,000. So it's balancing, you know, business and life as well when you think about it, which is you're making all that money, but it's all stuck. You're limiting, restricting yourself to £50,000, and therefore you're not going on that nice holiday that you've always dreamt of with your family, and that's what you actually you know, you started your business for. Just 1 second, please. Sorry, yeah. So as I was saying, we have salary versus dividends, but then there are other angles that can be explored, such as charging rent. Now, there is a slide coming up in terms of what happens if you have a limited company. And broadly speaking, as in the balance of the slides throughout this webinar would relate more to a limited company structure. So if you are a shareholder and or a director in a limited company, and the business trades from a premises that you own personally, then you can potentially charge rent. Now, when you think about it, one may say, okay, fine. So what's happening here? We own a property personally. Let's say you charge market value rent of £25,000 to the company. Yes, you get a corporation tax deduction of £25,000, and therefore potentially saving tax at 25%. So 25,000 at 25%, I think is 6,250. But then that £25,000 has to go on your self-assessment tax return, right? So you're paying income tax on that £25,000. So one may question, like, what exactly is the benefit? The key benefit there is the fact that you're extracting funds from the company. That's number one, cash funds. But number two is that there's no national insurance. So that's the key benefit when we're looking at charging rent and charging interest. There's no national insurance contributions. If we come back to salary versus dividends, there, you know, the key advantages there would be around the fact that dividends enjoy lower income tax rates against salaries. So we're looking at 20, 40, 45% versus dividends, 8.75, 33.75, and 39.1. Yeah, so it's a slightly lower dividend rates. But then the disadvantage is that dividends are not deductible for corporation tax purposes. Dividends are paid out of distributable reserves. So again, as I say, with taxation, with strategy, there are always pros and cons, and that's what needs to be looked at in detail. Benefits in kind, you know, accommodation benefit, company car, that kind of thing. Pension contributions, you have your normal regular pension contributions, and then you have something known as a small self-administered scheme, a SAS pension fund, which we'll touch upon going forward as well in terms of the benefits, the advantages. But broadly speaking, pension contributions are fully allowable for fully deductible, i.e. allowable for corporation tax purposes, and therefore immediate tax savings in the year that they are paid at 19 or 25% or anything in between. Consultancy charges or management fees or management charges, again, you're extracting funds from the trading business, and you know the funds may be paid to another company or to yourself personally. But the fact of the matter is the funds or cash is being extracted from the company. Whether it's exactly tax efficient, that needs to be looked at. You know, many people they think about setting up a company in Dubai and charging management fees, and that's what they go on about. It's not as straightforward as that. Expenses, I always tell clients, you know, maximize expenses as far as possible. That's a given. If you're not maximizing expenses as far as possible, with apologies, and then you want to talk about all this exotic stuff, it sort of like defeats the purpose, meaning that there's a methodology. You start from the basics and then you work your way up. If you're leaving expenses on the table, there was a business, a partnership business, professional fees of about £6,000. The accountant didn't expense the £6,000. Now, £6,000, let's say this is a partnership, so they're paying personal tax. Let's say £6,000 at 40% is £2,400. But then they're looking at all this other thing, which is, is going to save them a few £1,000s. But what I'm saying is that this £2,400 tax saving is just sat there, completely missed. It doesn't make sense. So there's a methodology. You work your way up slowly but surely before getting exotic. We have loans. Now, loans can either be related to benefits in kind, which is you can extract £10,000 from the business without any tax issues, meaning from a benefits in kind perspective. The only thing you do need to keep in mind is you may fall into Section 455 jurisdiction, you could say, and that's what needs to be managed basically. So up to £10,000, you're fine, but you then need to think about how it's going to be paid back. And then the other angle is loans. So one thing that we see occasionally is that funds are stuck in a trading company. Shareholder sets up a separate company, so not unconnected. It's not a holding company, linked investment company, whatever. It's unconnected and transferring loans from the trading business into the property investment company. Now, that's not, it's fine to a certain extent, but it's not advisable because regular loans can cause potential issues, and HMRC can also argue disallowable purpose. So that needs to be explored and considered. Capital proceeds, we'll come to this later on as well. But in a nutshell, the key comment to make at this moment in time, which is we're talking about remuneration strategies. So we're saying that it's always preferable to have the capital treatment rather than the income treatment wherever possible. Okay, so wherever possible, we utilize the capital treatment. Why? Because capital rates or capital gains tax rates are 18 and 24%, right? And potential business asset disposal relief versus income rates, which is 20, 40, and 45%. I hope that makes sense. There is a video, about a 45-minute video of me discussing all of these matters in more detail. And the key part of this slide is to subscribe to my channel. Okay, so we move on to personal or linked investment company, investment holding company, all these fancy names. It's all effectively talking about the same thing. But what this personal linked investment company, it's called linked investment companies because, and I'll show you a diagram very shortly, which is this here. But the reason it's a linked investment company is because you're linking it to the trade. So as I mentioned earlier, you have businesses, they're making profits of, hundreds of thousands of pounds, millions, and funds are stuck. They don't know how to extract the funds tax efficiently. And they have an idea in terms of what they want to do. So the most common one that we see is investment into property. Okay, the younger business owners like to invest in crypto. I've come across that one a few times, and stocks and shares as well. But let's just keep it simple. Let's talk about property. Now, the default position is that we extract, if we use an example of purchasing an investment property for £500,000, you extract £500,000 from the trading business. No, that's incorrect. From the get-go, that's not correct. Why? Because if you extract £500,000 to purchase a £500,000 investment property, that £500,000 is not enough. Why? Because you'd have paid 45% potentially, or at least 38.1% dividend tax. So you end up with £300,000, let's say. Okay, so therefore you need to gross up and you need to extract £800,000 from the company. You lose £300,000 to the taxman even before you've potentially even looked at a property. Okay, and it's just you're already in a net negative situation, and therefore that whole investing in property using funds from the trading business that's profitable, it's business owners feel dejected. They feel like, they're stuck. And that's where this linked investment company works extremely well. Why? Because we'll be eliminating the £300,000 personal income tax from the get-go. Why or how? Because we'd be utilizing dividends between companies, and dividends between companies are exempt for corporation tax purposes 99.5% of the time. Okay, so you have to still just explore, but 99% of the time dividends are exempt between companies. So it brings you the flexibility. How do we have flexibility? Because you can still extract dividends in your personal capacity on one angle, but then from the other angle, if you know what you want to do with the funds, for example, invest elsewhere, you have the flexibility to use that angle. We'll as I say, we'll come to the diagram, but it makes a lot of sense here. So you have this flexibility here. I'm not sure if you can see this, this blue cursor thing, but we have the flexibility between the individuals, and we have the flexibility with the family investment company. Introducing family members. So you may not want to introduce family members to the trading business, but you do want to introduce them to the property investment company, or the family investment company, which is now sat top right. So this allows you to have that flexibility, right? Technically, you may have other shareholders within the trading business, and and it just doesn't make sense to start adding your children and your wife and your husband or whoever it may be to this business, because this business is something else with my 3 business partners. But then this linked investment company, and each shareholder can have their own linked investment company. So you have the flexibility again, which is the fact that each shareholder may have differing appetite in terms of how to utilize their share of the profits, right? One may look to invest in property, the other may be riskier, as in the other may be interested in exploring crypto, and he or she may be younger, for example. So just different goals, different stages in life. Reducing tax and commercial risk. We say reducing tax risk. Why? Because we're trying our best to preserve business asset disposal relief and business asset disposal relief for capital gains tax purposes, and business property relief for inheritance tax purposes. If you start investing within the same company, then you are setting yourself up for disaster. Okay. Because now you've mixed trading and investment activity, and you can go onto my YouTube channel and I talk about trading versus investment activity. But that's what we mean by reducing tax risk. And commercial risk is, is the same thing, which is you're buying properties within another trade. You might be running an accountancy practice, for example, and a client sues you, and those properties are now potentially, those properties will now potentially be at risk. Okay. Separating activities, again, you're separating trade versus investment. Dividend tax management, the flexibility. Dividends can go either way. If you need funds for your lifestyle, your daily activities, your monthly activities, versus dividends to be utilized for investment purposes, and also exit planning on a very high level. We'll just use the diagram now. Let's say in this situation, we have X Trading Limited. X Trading Limited has received an offer of £5 million to be purchased outright. Now, one of the advantages we already have is we would look to explore something known as the substantial shareholding exemption, SSE, and therefore potentially pay no corporation tax on the disposal. Now, who's disposing? X Enterprises is disposing, right? It's not the shareholders. X Enterprises owns 100% of X Trading Limited. Have a 100% no. Now, Exit planning, when we say exit planning, the funds, let's say the full 5 million is now stuck in X enterprises. You have the full, again, the full flexibility in terms of where the funds are going. Okay, where the funds are going. It's a very beautiful structure. You know, I like to make things very colorful because to make it look even more beautiful. But then here you have the family investment company where the diagram, you know, I need to edit the diagram, but effectively you can have children there, you can have a trust there. Trust planning is very important. Technically, you can have a linked investment trust. You know, if you think about it, you can have a linked investment trust potentially as well. I hope that makes sense. Do we have any questions at this stage? Any questions? You can feel free to put in the chat box or unmute yourself. Okay, let's move on. This time, okay, behind. Fine. So we have research and development. Research and development tax credits introduced back in 2000, and over the last, let's say 2018, let's say over the last 7 years, really gained popularity. And then over the last 5 years, really gained popularity for the wrong reasons, inflated claims, fraudsters, and the rest of it. And therefore, the whole landscape of R&D has changed. And therefore, you can't wing it anymore, okay? But for us, we see this as an opportunity because we know exactly what we're doing. So when it comes to R&D, you just have to be, you know, the key point to take away for business owners here is that there is an angle of if you are undertaking work in research and development, so technological or scientific advances within your industry. There is potential tax relief at 86%. So as I say, I can talk about R&D for a long, long time, but the main awareness I want you to take away from this slide is that is my business undertaking R&D work, or is my client's business undertaking R&D work? That's the first question. And then capital allowances, whereby, you know, are we maximizing our capital allowances claim? Again, we see many expenses that, you know, have been completely missed out. So, for example, if you purchase a commercial property, a warehouse, for example, a lot of assets are missed out for capital allowances, and you know these are easy tax deductions that one may be missing out on. Patent box, however you pronounce it, film tax relief, animation tax relief. There are other angles as well to consider. The key takeaway from this slide, as I say, is the awareness that the government do provide incentivization for certain industries, and you need to always be aware that, you know, there's a potential claim here, or is there a potential claim, or are we missing anything out? We have a question. When sending funds upwards to the holding entity, that's classed as dividends. When sending to the investment company, is it still classed as dividends? Good question. The answer is yes, it's still dividends, because the linked investment company is a shareholder technically within in the holding company, right? So it's dividends, correct. And dividends are exempt for corporation tax purposes. EMI share schemes, most popular. This is where we're looking to incentivize key staff. Incentivize key staff, motivate, retain top talent. These are the three main angles. I believe that these have become popular over the last few years as well. You have a lot of these online firms, for example, Seed Legals, I think Vested is one of them, if I'm not mistaken, who are, you know, mass marketing these kind of opportunities for business owners, which is, you know, which is good stuff, as long as, you know, everyone is benefiting and there's, you know, people are utilizing what's available to them, then it's good stuff. Obviously, when it comes to price, we can't compete with these online firms, just to be clear. And, you know, you won't get the full support that you'd get, you know, working directly with a tax firm. EMI most popular. Why? Because of the tax advantages. Again, I can talk about these three for over an hour, but again, it's for the awareness. CSOP, company share option plans, are not as popular, to be honest. Why? Because you have the restriction in terms of the value that's available. And growth shares, I believe, are becoming more and more popular, actually. So growth shares are another mechanism to bring in new shareholders tax efficiently, effectively. Okay, so it works different to EMI shares, but it's still quite beneficial, it's still quite useful. Okay. Okay, that's fine. I think we've got another message. No. Okay, so then we have the trading premises. We touched upon this earlier. We said that we may have a shareholder, and it is quite common, as in, don't think it's like completely uncommon. It's something that pops up every now and then. We have the trading premises that's owned personally by the director shareholder, for example, but the trade, so the limited company effectively utilizes the premises. Who should own the property? This is a question that needs to be asked. Again, there's pros and cons, but we mentioned one of the advantages, which is extracting funds from the company without paying national insurance contributions. How do we fund the acquisition? And a SEIS pension fund. The key point of this slide is the SEIS pension fund, where we're looking at commercial property. Now, on a very high level, a small self-administered scheme is an incredible and powerful tool that I believe is unutilized by business owners. Why? Because of the tax advantages. When it comes to taxation, I'm very open in saying that usually there's always pros and cons. So that's what needs to be balanced out. Like, you can't have your cake and eat it when it comes to tax. For example, if we're looking at a trust, slightly off topic, but if we're looking at a trust, you may benefit from an inheritance tax perspective, but you lose control, for example, right? So where it doesn't always have to be a tax advantage, it's tax disadvantage. Sometimes it might be commercial or real life. But the SEIS is one particular angle where I genuinely believe that you're having most of your cake and you're eating it. You know, benefits are that funds that are contributed into the SEIS in the first place are fully tax deductible for corporation tax purposes. That's number one. So immediate tax benefit. Number two, and I'll just quickly touch upon the disadvantage, which is obviously it's a pension fund. So we're thinking long term. You can't just transfer funds and transfer out the next day. It doesn't work like that. It's long term thinking, and it would suit business owners that are that have the excess funds and they don't really need it for the foreseeable future. Okay. If you're going to ask me about a SEIS pension fund, but then the next question is going to be, oh, so can I withdraw in 2 years' time? You know, it's you know, that's the end of the conversation, basically. So it's a long-term, it's more of a long-term thing. But the benefit is that once funds go into the SEIS can then purchase the trading premises. Okay, so you've got your full corporation tax deduction when you're transferring profits from the trading business, the limited company, into the SEIS. So let's just say £200,000. So immediate tax saving of 25%, which is £50,000. The £200,000 is now sat in the SEIS, which can potentially purchase the trading premises. Okay. Now, the next benefit, so we're not done yet. We're saying that the SaaS has now purchased the trading premises. The business, the limited company on this side, uses the trading premises. So the SaaS charges rent, market value rent, let's say £30,000 to the trading business, the company, and the trading business gets a full £30,000 deduction, therefore saving tax again on an annual basis. But the magic is that the SaaS pays no income tax, no corporation tax, no capital gains tax, and no, I was going to say no inheritance tax, we'll come to that. And no income tax, no capital gains tax, no corporation tax. So effectively, the SaaS, you're getting a deduction on one side and you're not getting taxed on the other side, which is a win-win. And it's not very common when it comes to tax matters. The inheritance tax position, so previously one of the selling points I would say was around the fact that a SaaS is free from inheritance tax. However, since the budget last year, we have potential new rules to be introduced in April 2027, so 2 years from now, whereby SaaS pension funds would come back into charge for inheritance tax. However, if you have clients stuck with this issue, please reach out, because we do have solutions that are ready to go in order to help minimize or eliminate this issue. I hope that makes sense. Property business, we have two types. We have a trading property business where it's property development, buying and selling property every few months, every few weeks. You might have hotels, car parks, and you have investment where property is generally held for the longer term and for the income it can generate, usually by letting. So this is where we have, again, trading versus investment activity. Very, very important when it comes to tax planning. Business asset disposal relief, business property relief, substantial shareholding exemption, company purchase of own shares. The trading condition is quite common. When it comes to the rules, trading condition is quite common. If there's an overlap, it requires professional input. And we have residential business. So we have potential incorporation of a residential property business. I think that's what I was alluding to there. Because the conditions for incorporation relief doesn't mention the word trade, it mentions the word business, and that's where the whole potential opportunity comes up. If you have if you're not really running a business, or you might have 20 properties, so an advisor or an accountant may get excited and say, oh, 20 properties, yes, you're running a business. But then you look into it for 5 more minutes and you find that an estate agent is managing everything for you. There's no business, right? And on the flip side, you might have someone with 10 properties, but completely looking after everything themselves. So that's where you can start, preparing an argument. But why do property landlords want to incorporate? Again, slightly off on a tangent, but something that we are regularly involved in. Mortgage interest relief, so Section 24 restrictions that were introduced back in 2017, and 2020 was when the full negative effects were realized. Within a company, there's no restriction on mortgage interest costs. There's other things such as the immediate capital gains tax uplift of the properties once you incorporate into a limited company. So for example, if you're selling a property that's sat on a healthy gain, you're literally wiping it out the next day. And then there's inheritance tax planning, which is easier when you're looking at shares versus properties. I can talk about that as well. Do let me know if that's an area that you want me to discuss in a future webinar. Insertion of a holdco. Many benefits here as well. Did I put in a diagram? Yes, I have. So asset protection, separating de-risking trades, group loss relief, SDLT relief, tax-free dividends, potential SSE on sale. So if you have this diagram, you have, husband and wife, let's say, they have they are 100% shareholders between themselves, whether it's 50-50, 60-40, whatever it is, but they're owning two companies, 100% here and 100% here. If you insert the holding company, you've immediately opened up the potential for something known as the substantial shareholding exemption, which was not available on the left-hand side. Why? Because it's only available for corporate entities. We've opened up the angle of having a cash box, for example, where dividends can go up between the two companies and accumulate in the holding company. What else did we say? We said, let's just say, for example, you had one trading company, but within the one trading company, there was about 3 trades, and we've seen this many a time. You insert the holding company, and then you have 3 separate subsidiaries. Group loss relief, SDLT relief. So, for example, properties can move within the group completely free from stamp duty, land tax, as long as certain conditions are met. Assets can move completely free as well. So you may have owned a let's just say a warehouse in trading company 1, but for legal protection purposes, you want to transfer into the new holding company. As in, forget that, you want to protect this warehouse. What can you do on the left-hand side? There's nothing much you can do tax efficiently, because if you sell the warehouse to yourselves as individuals, there's immediate capital gains tax, because separate legal entity, right? Separate legal entity between the individuals and the company, and therefore market value sale, even though it may be a gift, for example. Here you have the holding company that's introduced, and the warehouse can now move completely tax-free. Why? Because you have a group for capital gains tax purposes. Same goes with stamp duty, land tax. Same goes for loss relief. Loss relief, you may have 5 companies, let's say, okay, but one of them is making massive losses because it just started trading. It was expected to make losses. That's fine, but that particular trade, it was like an experiment for yourself, right? As a business owner, as an entrepreneur. And if you don't restructure, those losses can potentially be wasted, because, as I say, it was an experiment and you've incurred losses of £1 million, let's say. It could potentially be lost, as in completely wasted, because it's stuck. Once you introduce the group structure, that loss can then be offset against profits of related companies within the group. There are rules when it comes to percentages and other rules as well, but on a high level, those are the benefits. Do we have any questions? Okay. Yeah, as we mentioned, going downwards is a loan. So the question is, when you insert a holdco, the trading company will issue dividends to hold. And what if you want to give the funds to the investment company going down? Is it classed as dividends or a loan? As dividends can't be passed down, correct. Your dividends can't be passed down, and therefore it's a loan going downwards. That's completely fine. Broadly speaking, this is me getting a bit more technical now. I never advise having an investment company over here. Why? Because you're diluting the group. I see so many advisors, they advise this kind of structure where you have the property investment company bottom right. That's not advisable. You're setting yourself up for failure, and it's very basic knowledge without really, thinking in more detail or the longer term potential implications from the advisors if they advise in that kind of structure. The reason I've put investment companies to make that point, but also because I've seen that many a time. And other advisors have advised this kind of thing. I don't advise that. But yes, going down would be a loan. Your other question is, when you have property in your own name and want to transfer this into a limited company, what are the tax implications? On a high level, if you have property in your own name and want to transfer this into a limited company, the tax implications that you need to consider, as in that's something you need to take formal advice on, because each case is very specific, but you need to consider stamp duty, land tax, and capital gains tax, as well as potentially income versus corporation tax, but the main aspects would be SDLT and CGT. Okay, fine. Okay, so we're definitely going to go over time. I hope that's okay with you guys. But I will, try to whiz through as quickly as possible. Demergers. There's 3 types of demergers. This is very complex stuff. Statutory demerger, capital reduction demerger, liquidation demerger. I would say capital reduction and statutory are most popular. Capital reduction is most popular. Why? Because it allows for the splitting of property investment groups, whereby statutory is specific for trading businesses. There are many reasons why you would undertake a demerger. Preparing for a future sale. So, for example, I'll touch upon this later on, where you want to separate trading and investment activities. So we come back here. You're stuck now with this. If you have investment properties, for example, within this company bottom right, you're stuck, right? So then you need to look to demerge. That's a case that we regularly work on. Like, as in I've seen so many times now where trading and investment has been mixed, and therefore we need to look to demerge. And that ties in with preparing for a future sale, because you might want to sell your trade, or you might have received an offer for a trade, but you don't want to sell your investment properties, and they don't want your investment properties anyway. So you need to prepare, and the only way you can do that tax efficiently is via a demerger. Making the company more attractive to potential investors, that connects to the first 2 points as well. Locking in CGT and IHT reliefs only afforded trading business. Again, technically, it connects to the first 3 points. And solving shareholder disputes you may have. It might not even be a dispute. I say dispute, but I've worked on so many cases. I've got one case right now as well where everything's amicable, which is 2 families, 2 brothers, as in they're looking to go their own ways. There's no beef, as they say. It's just, they want to go their own ways, but sometimes there can be disputes. And, we need to separate things out. This is complex stuff. The tax savings are, significant. And, there's, tax and legal fees as well that need to be absorbed. EIS, SEIS, different rules for each scheme and conditions. We're not going to go into them. But the key point, again, to take away from here is that you can raise funds for your business using EIS and SEIS, bring in your business benefit and bring in the investor's benefit as well. Okay, so that's what EIS, SEIS is about. It stands for Enterprise Investment Scheme, Seed Enterprise Investment Scheme. Different, as I say, different rules for each scheme and conditions. The SEIS, the tax relief is for the investors. Now, if you're thinking a bit more broadly, a lot of investors these days, they ask, is the business qualifying for these schemes? Why? Because the investor gets a 30% or a 50%, shall I say, income tax credit. I'm not sure if I've used the correct terminology when I'm saying income tax credit, but effectively what we're saying is that the investor, imagine, that's the point there, untapped potential here. I believe it's unutilized. Why? Because the investor invests into a business, let's say £200,000. They are knocking off £100,000 of their next tax bill. Okay, so it's a win-win for both the investor and the investee, and we can help with the advance assurance from the HMRC. Buying a business, acquiring other businesses comes with financial, commercial, and tax risks, which all need to be managed. Trade is safest, shares is simplest. Now, buying a business will be offset against selling a business, because when you're buying a business, usually you just want to buy the trade, okay? Why? Because you're not carrying any baggage of the company. But when you're selling a business, and this is where the dynamics lie, you want to sell your shares. Why? Because there are further tax advantages, and also you are avoiding double taxation. Sorry, I'm just checking something with the LinkedIn. Fine. Shares is simply, okay, trade is safest, shares is simplest. Okay. Tax due diligence ensures that you aren't going to get any unwelcome surprises from HMRC post-acquisition. So it's important to obtain tax advice when buying a business. On a very high level, it's better to buy a business via another company. So if we're coming all the way back here, and this structure works well because you can insert new businesses seamlessly, and there are tax advantages for buying a business using a corporate entity or corporate vehicle. Exit planning, you have many options available for many angles. You have the third-party sale, shares versus trade and assets. Third-party sale, meaning you're selling to a third party. You have the argument again. You want to sell the shares. Why? Because you want business asset disposal. They don't want your shares because the company's been incorporated in 2005, for example, running for 20 years, and it's got a whole load of history. They're not interested in that. But then you're not interested in that because you're not interested in selling your trade and assets, because when you sell your trade and assets, the cash remains within the company. So you have the issue of how do I extract the cash? But then I'm thinking that the cash is within the company. Maybe you want to invest elsewhere. So, you know, pros and cons needs to be discussed. Tax due diligence, very important. Company purchase of own shares, a tax efficient mechanism where we look to claim the capital treatment instead of the income treatment for an exiting shareholder, where the company purchases the shares of the shareholder using the cash reserves that are potentially available. Sale to an employee ownership trust, gaining popularity. Why? I would say probably due to the tax advantages, let's not lie about it, where you can sell completely tax-free, but then there are other advantages, which is, you know, you maintain the culture of the business, the next generation of the business continue to grow the business. And then as with everything, there are negatives. Management buyout, again, something similar to an employee ownership trust, structured correctly, you can structure things without any tax charges or significant tax charges. A typical shareholder acquisition, an acquisition by newco, slightly connected, and that's where we're starting to look at things like family members transferring the assets or introducing family members to take over the business. Trade sale, we mentioned. Due diligence, very important. We're looking at both the company and the owner, right? So we're quantifying the tax, you know, what reliefs are available, helping with the refining of the proposal, protecting from tax risks, and then inheritance tax. Why? Because we mentioned there, trade sale, trade. Now, trade carries advantages, as mentioned many times throughout this webinar, when it comes to capital gains tax purposes, but also for inheritance tax purposes. Although there are new rules coming in from April 2026. But what we're saying is that there's a relief available called business property relief. Okay, yeah, so it's over here. Business property relief, which allows for the ownership of shares in a trading company to be completely free from inheritance tax. Okay. Now, what happens is when you're selling your trade, what's happening? Think about what's happening. You're swapping an inheritance tax-friendly asset for a non-friendly asset, which is shares in a company versus cash. The cash is not friendly for IHT purposes. So that's what we need to think about. And that's why inheritance tax planning is very, very important. It's crucial early as possible prior to sale. Why? Because there's many tax planning opportunities that can be explored. Any business owner, so if you have clients or if you're a business owner, any business owner where they have the valuation of the shares in the company exceeds £1 million, they must, or you must seek our advice as soon as possible. Why? Because from April 2026, there'll be a cap on business property relief to £1 million. So any trading business that exceeds £1 million, and that can be many, I'm pretty sure many of your clients, you know, will have businesses worth over £1 million. They need to take proactive action from now. We're hitting June in a few days. So June, July, August, September, October, November, December, Jan, Feb, March. They've got about 10 months. They need to seek advice now. There's strategies that we can explore, and we can help mitigate the reduction of business property relief. Redeemable preference shares, that's another tax planning angle. Will trust, growth and freezer shares for investment companies. These are all tax planning angles that we can explore. That's how Aswat Tax can help you. Any stage throughout yours or your client's business life cycle, we can, proactively get involved. I know many of you as accountants, 50, 60% of your time every week is spent, managing client relationships and other kind of aspects. Most of you'll already have the awareness, but it's about actually implementing and executing certain projects and transactions. And that's where we would be delighted to help and support you. It's important, that I think the main thing is that all parties involved leave happy, and ultimately it's the client top of the chain, meaning that if they have potential tax planning opportunity which are being missed out, we can proactively get involved and assist in executing certain planning for them. As I say, this business property relief is very important and needs to be looked at. It's becoming urgent as the days go by. That's how Aswat Tax can help you. I hope you enjoyed this webinar. Do we have any questions? As I say, the main thing here was about the awareness, the wider awareness. And, I've mentioned quite a lot of planning opportunities that need to be explored. So I hope you found it beneficial. I hope you found it useful. Do we have any questions, or shall we call it a day? Thank you so much. Really, really insightful. Thank you very much, Layla. Do you have to pay the loan back within 9 months and 1 day? No. I'll double check this, but the section 455 rules is not related to companies. Is it? No, it's not related to companies. So you don't need to pay back within 9 months and 1 day. Thank you very much, everyone, for your time, and pleasure having you on. The next webinar, these are my details, Omar, UK, website, socials. Thank you for the session. Thank you. And the upcoming webinar next month is family investment companies. Again, a powerful tool when it comes to not only property investment companies, but also trading companies. Looking to bring in the next generation. Family investment companies is the go-to. I hope you found that beneficial. I hope you found that useful. Reach out to me anytime, and always happy to discuss, always happy to chat. I shall speak to you soon. Thank you, and have a great day.